Hey everyone, welcome into this special Federal Reserve edition of Market Takes. I know you could have been anywhere in the world, but you're here with me, and I appreciate that. I am Dion Rabouin, reporter at the Wall Street Journal. We are diving into today's FOMC meeting, the Federal Reserve making their decision on monetary policy. We're going to break down everything they said, everything they wrote down, and what we learned from today's FOMC policy rate decision. Of course, we're going to talk about the rate decision, what it was, and how that aligned with expectations coming in. We're going to check out the markets because I think the market action today is very interesting in response to what the Fed came out and said. We're also going to talk about the summary of economic projections and the dot plot. We don't always do that, but I think the information in the dot plot and the summary is really what moved markets, and that's going to be really telling for what we see going forward through the rest of the year. And of course, we're going to talk about the Powell press conference and what comes next. So first things first, the Fed held rates at 5 to 5.25%. That was largely as expected. We got what I would call a hawkish statement with a dovish conference. So the statement out from the Fed really kind of leaning in, hey, we are going to raise rates more. We're going to slow down the economy. We're going to make it more expensive to borrow. And then Powell came out and was like, well, you know, maybe we'll do that. Maybe we won't. We'll see. Fed was expected to hold. That was largely priced in the market. So this line really, no surprises, no big moves there. But the big surprise was in that summary of economic projections. The Fed predicting that they are going to raise interest rates 2 more times this year at least. And we're going to dive into what all they said in that summary of economic projections, as well as their dot plot. Also some surprising projections about what's going to happen with the economy on inflation, on unemployment, on growth. All those things coming into play when we looked at the summary of economic projections. Coming into the meeting, Fed Fund futures showing that there was an expectation the Fed would raise rates next month, so that this would be a skip, as in the Fed would skip raising rates this meeting and raise them again going through the rest of this year, at least once in July. That was largely priced in. The other alternative was that the Fed would pause, as in stop raising rates and not have any more rate hikes throughout the rest of this year. That's what they had been projecting coming up through March. We've seen a bit of a change in strategy now moving forward. So investors really not feeling great. There was a lot of confusion in markets, and as we look through the reaction of markets, you're going to see a lot of confusion, a lot of things going up, then coming down, then going back up again. It was really that kind of day in terms of the way the market interpreted the Fed. So let's get down to business. Let's check out the markets right now and what we are seeing from the way markets reacted. What you see up there is the Dow. The Dow finishing down about 0.7%, but you see the S&P 500 and the NASDAQ both finishing in the green. I thought this NASDAQ chart was really interesting. Now, right here you see this is right about 2 o'clock when the statement comes out. You see stocks fall and just fall and fall and fall. And then we get to a point when we hit the Powell press conference and stocks really took off, rising in a big way. And then Powell said a couple things about core inflation, talked about PCE, stock prices went down on the NASDAQ, but then finishing the day ramping up and finishing the day higher, 0.4% higher. So the positivity in the NASDAQ and the S&P 500 continued that we have seen. I think we've seen about 5 straight days of higher stock prices there. When we go into right here, the NASDAQ and the Dow, as you see, Dow again down, but really interesting for bonds. Look at the 10-year note right here. You see again that big pickup right around 2 o'clock. Bond yields jump up higher and then kind of come back down and settle. And you see, you're kind of going to see this across the board when you look at the yields on U.S. Treasury bonds. Similar action in currencies, in commodity markets. You see crude oil futures right after the Fed meeting really taking a turn down lower and then kind of picking up, going higher. Gold, a similar thing. You saw right around that 2 o'clock time, really gold prices went down in a big way, but then came back up, finishing the day a little bit positive. So that really just illustrating that markets overall did not know exactly what to make of this statement and summary of economic projections, and then the press conference, all three kind of saying different things. So the changes, I think, to the statement were pretty minimal, right? The biggest change was adding language saying that they're going to take this month as a pause to give the Fed time to, quote, assess additional information. We saw that, and that was what they said, but really markets still kind of pricing in, okay, well, you said that, but let me throw up here on your screen right now the summary of economic projections, the dot plot as it's known, and that just shows what the Fed expects to do with policy. Now, I know this kind of looks like a UFO, but let me explain what you're looking at. For 2023, this is where participants on the FOMC, the decision makers on the Fed, think that rates are going to go. Now, up there you see 5%, and no one is in that 5% to 5.25% camp. There's really only 6 people between 5 and 5.5. Almost everybody on the committee, all those dots you see up there, are between 5.5 and 6. And you've got some folks on the committee expecting the Fed is even going to raise rates to 6% by the end of this year. Now, keep in mind, there's only 4 more meetings through the end of this year. You've got July, you've got September, November, and December. So if the Fed is going to raise rates to 6%, that would be a rate hike at every single one of these meetings. Most folks are a little bit below that, 2 more rate hikes, so a rate hike every other meeting, but a pretty hawkish outlook in terms of what we can expect to see from the Fed in terms of policy. Folks saying, you know what? We think we need to raise rates even more than they are. Remember, coming into this meeting just in March, the Fed had said we're going to hold rates or raise rates to about 5%, which is where we are right now, and then keep them there through the end of this year. The Fed's saying, no, we need to raise rates 2 more times. So 2 more rate hikes, making monetary policy even more expensive, making those credit cards more expensive, making loans more expensive, making all those things at least half a percentage point more expensive. And again, if you're borrowing from a bank, probably a lot more expensive than that for you. Then 2024 and 2025, expecting rates to go down. So the chart you see there, that's the dot plot, just illustrates the expected path of monetary policy. The Fed doesn't make any guarantees. They just say, this is what we expect. This is what we think will happen. And I think that really is why you saw those big swings in the market that we talked about or that I showed you there, from stocks, bonds, you saw it in commodities, all those sorts of things. And that was really in response to the summary of economic projections. Then you got the dot plot, and then you had Fed Chair Powell's press conference, and that was interesting in its own right. I think folks were really not sure what to make of the chairman because he did a couple interesting things. One thing that I noticed is when he talked about why the Fed had expectations for, the other thing were in the summary of economic projections, haven't even talked about that. The summary of economic projections said that not only do they expect to see these 2 more rate hikes, they also expect the economy to do better, and they expect unemployment to hold a little bit higher than where it is, but broadly be lower than where they projected it in March, and they expect inflation to come down even lower than where they had it, even lower than where they expected it in March. So to take a step back, the unemployment rate is expected to rise just 0.4% between now and the end of the year. The Fed had previously expected unemployment to rise almost 1% between now and the end of the year to 4.5%. They now say only 4.1%. Now, that's big when you think about that, because if unemployment is only going to rise 0.4% between now and the end of the year, well, in May, when we got this last jobs report, the unemployment rate rose 0.2% when we added 339,000 jobs. So we added jobs. We had a very strong unemployment report, and you still saw the unemployment rate rise 0.2%. So by the end of the year, the Fed is saying, despite us raising rates 2 more times, despite all the bank crises we've seen, despite all of these things that are going on in the economy, we still think the unemployment rate is going to hold at this very low level and rise just a smidgen, just a little bit more than it rose in a month when we had 339,000 jobs added. That is a very rosy prediction. The Fed also expecting inflation is going to fall to 3.2% on PCE. PCE inflation was 4.4% at the last reading for April. So the Fed projecting that inflation has a lot further to fall. That's even more interesting given that PCE inflation actually rose last month. It hasn't gotten as much attention as CPI, which has consistently been coming down. If you watch market takes yesterday, we talked all about that. PCE inflation had been coming down a little bit more slowly, and then it picked up last month. And now the Fed is saying, we're not even worried about that. It's not worth thinking about. We think that inflation is going to keep coming down all the way to this 3.2% note. That's really interesting. And then their expectations for GDP growth were that GDP will rise 1% this year. So previously the Fed had expected 0.4% GDP growth. They're now saying we think GDP is going to grow more than double our previous expectations. Not only are we going to avoid the recession, we're not even going to get close, and GDP is going to grow near trend growth, near what a normal year would be after a big blockbuster blowout year in 2022. that is a very rosy and a very optimistic projection that I think has gotten a lot of folks in the market kind of scratching their heads. And again, when you look out at the markets, that's why you see a lot of that uncertainty, a lot of buying, a lot of selling, markets moving up, markets moving down, and people not even really sure what to make of that. So again, the SEP, the Summary of Economic Projections, says where the Fed thinks monetary policy will be and where they think the economy will be at the end of the year. As we know, they adjust that every 3 months. They adjusted it in March. They adjusted it at this meeting in June. They'll adjust again in September. And of course, at the end of the year, they'll say, okay, this is what happened and this is what we think for next year. So that's what we get with the Summary of Economic Projections. And it was very rosy, very exciting. And it doesn't quite align with a Fed that thinks, okay, inflation is so out of control. Not only have we raised the rate to what we said was already tight monetary policy that was cutting off and slowing down the economy, which is where they said we were now. Well, now they're saying we have to raise rates even more, but we also think that GDP is going to be higher. We also think unemployment will be lower. We also think that inflation will be lower than what we told you in March. Those two things don't really add up, and I think the market isn't really sure what to make of that. The Powell press conference specifically, Powell didn't really adjust these things. Like I said, when he talked about why the committee wanted to raise rates, he talked about that PCE inflation and specifically talked about core PCE inflation, which is even higher. So inflation, when he wanted to talk about why the committee needs to raise rates, why they need to do more, he cited one metric, which is core PCE inflation. That measures things a little differently. When he talked about why are your outlooks so rosy, why do you think unemployment will be lower? Why do you think GDP will be higher? Why do you think that inflation will come down more? He said, oh, well, look at CPI. CPI is down at 4%. It had been as high as 9%. Look at the progress we've made there. So very interesting, because if the Fed is looking at this data to make its projections, they're obviously looking at both PCE and CPI, and they have to make a decision based on that. Well, it seems like their decision making about the expectations for the economy is based on one thing, and decision makings about what they're going to do and how they're going to operate policy based on another thing. Very interesting, and very interesting to see. So core inflation, Powell said, quote, we're just not seeing the progress that we want to see. Very interesting, and that again deviated from what they said about why they project the economy will do so well the rest of the year. I think the biggest takeaway from the Fed and what we heard this year is there are a lot more questions than answers. I think when we get a lot of these Fed speakers coming out the next few days and the next few weeks, there will be a lot of questions on, well, what did you think? Because very clearly the committee is not aligned. You've got a lot of folks on that same baseline saying we expect 2 more rate hikes, but why do you need to raise rates so much if you already expect inflation to come back down? Why raise rates so much if you're thinking that unemployment's going to stay low? All these things that would lead to this great outcome, this very optimistic outcome, don't seem to align with an economy that needs 2 more rate hikes when the Fed has told us we are already at restrictive monetary policy. And that's usually when things start to fall apart, and why we got some of those issues with the banks, or at least that's the bank said, why we had that. So we could see more. There were a couple questions during the press conference about whether more bank crashes or bank runs might spur the Fed to pull back or hold back, and Fed Chair Powell didn't really want to talk about that very much. I think that's the biggest takeaway from this meeting, is there's just a lot of uncertainty, and I think there will be a lot of questions for Fed officials in the coming days and weeks. So what do we do next? Well, tomorrow retail sales is out. That report is going to be big. Economists predict that retail sales will be negative. Again, that would make 5 of the last 7 months in negative territory. And if you've been watching Market Takes, you know we have seen a consistent decline in year-over-year retail sales. That might be something the Fed wants to worry about. So check that out tomorrow morning, 8:30 a.m. Retail sales will be out. It is a big week next week for housing data. Got existing home sales, housing starts, and home builder confidence. All those metrics have been moving up. Fed Chair Powell was asked about that in his press conference as well, and he said, yeah, it's something we're watching, but not really something we're worried about. I think you'll want to be watching that as well next week. We'll be right here, Market Takes, breaking down the existing home sales report. That's the biggest one. Also, we are back on Tuesday because Monday is Juneteenth. Happy Juneteenth to everybody out there. We are off Monday, but we will be back with you on Tuesday morning, 10 a.m. for Market Takes, previewing the week ahead and what comes next. So I hope you'll be with us as well. That's going to do it for us here on Market Takes. I am Dion Rabouin, reporter at the Wall Street Journal. Thank you so much for being with us. I hope you'll come back and do it with us next time.